Mr. Jacob McCarthy, who has served in the capacity of a collateral analyst. He currently works with the First National Bank. He spent over 6 years of his time understanding Ghana's mortgage system, helping people acquire their mortgages. He has an extensive experience that he will be sharing with us today as we advance in this meeting today. We will be having, this session is going to be more of a conversation, questions and answers. So what will happen is, at a point, if you have a question, you can use your reaction button to indicate that you have a question you want to ask concerning the discussion that will be going on now. And then if there's any other thing, the chat section is also available. You can indicate there and we'll respond to you quickly. All right, so like I've said, I've introduced our panelists already. Mr. Jacob McCarthy has over 6 years experience in the area of mortgage analysis, and he's helped many people in going about acquiring their mortgages and also financing their properties. And today he will get to share his experiences with us in the industry and how that could also help us in our future endeavors. So, Sir Jake, please, are you there?
Yes, I'm here, Godwin.
All right.
Thanks
All
for the
right.
introduction and good evening to all on the call.
All right. Thank you very much for making time for us today and to share your experiences with us as well.
You're welcome.
Yeah. All right. So to begin with, I would like you to give us a breakdown of really what the mortgage is about and what one needs to know before applying for mortgage. And we'll get into the details of the discussion later, where more questions will be made from this side and also from the participants that are on the call today, like I mentioned earlier. So for now, just give us a breakdown. What do we need to know when applying for mortgage? How's the terrain in Ghana? And how is everything concerning the mortgage industry? Thank you.
Okay, thank you, Godwin. So basically, when we talk of mortgage is a loan just like any other loan, but it's a long-term loan that is usually between 5 years to 30 years, and it is secured with a landed property. So when I talk of a landed property, it's either a bare land, a residential property, a commercial property, or an industrial property. For the purposes of our discussion today, I would like us to focus on home loans, which means that mortgages that the purpose is to either finance the purchase of bare land or a residential property, or where you have a residential property and you want to release equity in that. I'll go into the details of what release of equity means subsequently in my presentation. There are two words that I'll be using interchangeably, not only to a couple of them. So I'll be using borrower. So in a mortgage contract or a mortgage transaction, the borrower is called the mortgagor. And then the lender, which is mostly a financial firm, is the mortgagee. So I may be using the mortgagor and borrower interchangeably, as well as lender and mortgagee interchangeably. There are different types of mortgages, basically three. We have legal mortgages, we have surety mortgages, we have equitable mortgages. What our discussion will cover today will be legal mortgages. When we talk of legal mortgages, basically in a legal mortgage, the one providing the collateral is the borrower. So it's either the borrower is going to buy a property or the borrower has a property that he or she is mortgaging to a mortgage firm, which in this case is the mortgagee, for a loan. And in a surety mortgage, just like a guarantor or a guarantee, you are just giving a guarantee for somebody's responsibility to pay or to fulfill an obligation. So in this case, the borrower in a surety mortgage, the borrower is different from the one providing the property, who is the mortgagor. So I think the terms are a bit confusing, but let me just try and touch on them, but we'll be dwelling mainly on legal mortgages. So if you get the explanation on surety mortgages, the one borrowing from the mortgage firm is not the one who has the property. So in a surety mortgage, it's more or less like an equity release. You have a property and you are bringing this as a collateral for a loan. But in this case, the one borrowing, for instance, is Mr. A, and Mr. B is the one providing the collateral, which is the property to support the loan that Mr. A is applying for. We also have equity mortgages. They are kind of a backup collateral that a bank or a financial firm will hold on to, just so that in the event that the borrower is not able to perform, then the mortgage firm will fall on that property to pay off the loan. I mean, in this case, they will sell it and pay off. So Godwin, basically, that is about mortgages. I think you also want me to go ahead and talk about what we need to know. Okay, so one thing that as a would-be mortgagor or borrower would have to know is that you need to pay off your debt. What do I mean by paying off your debt? So your current debt or your existing loans that you have, even with MTN Momo, all those things affect your credit worthiness. So because of that, if you have any debt that you need to pay down or you need to pay off if you have the capacity, you need to try and reduce your debt, because there is something we call debt to income. With the debt to income, it looks at how much or the percentage of your income. Godwin, hi Godwin, can I be heard?
Yes, we can hear you, Claire. If you could also help us by putting on your video, because the participant want to have that engagement with you, please.
Oh, okay, sure,
Yes.
that's fine.
Yeah.
I'll put on my video. Just a moment. Just a moment. Some people are asking for the link. Let me just forward that to the person. Just a moment.
Okay, sir.
It's actually on the flyer, but they've not paid attention to it. So yeah. Okay. Apologies for that. Let me turn on my video, then we can have a better discussion. Okay, I guess we are good to go now.
Yes,
So
sir.
I was talking about debt to income. So the debt to income looks at the totality of, or the percentage of your income, your monthly income in this instance, that goes into repayments of your existing obligations or debt. So if you have loans that you need to repay, you need to make sure that you are paying the loans on time, because your credit history would affect your affordability, or it will affect your credit worthiness. And then the bank would always look at that to see whether you are good in terms of a good customer that they can take on, or a bad customer. So if you have to pay your loans, you need to make sure you pay your loans on time. Even with MTN Momo, you need to make sure you pay that. Then There is another thing that we need to take into consideration before applying for a mortgage, or you need to know. And I think I factored it into the paying of your debt, which is making timely payments of your loan. So as I mentioned, if you default on your loan, it affects your credit worthiness. And then the bank will always look at that in their affordability. You need to also save down towards payments of your down payment or your equity contribution, and then again, payment of other fees such as processing fees and closing fees. So in a mortgage application, you are required to pay an amount of money. Normally, it's called an application fee, and that money is used to run due diligence on the property that you are bringing for the loan. They also carry out valuation to ascertain the value of the property, and that is very key. You need to make financial plans towards that. In most cases, most mortgage firms, they do a loan to value ratio of 80%. When I say loan to value, for instance, if your property's value is say 100,000, the lender or the bank would usually do 80% of that value. So in this instance, that will bring it to 80,000, either Ghana cedis or USD, whichever currency. So you need to save towards your down payment. You need to prepare because most banks will not give you 100% financing. You'll be required to make some commitments upfront. Apologies, Godwin. I think the video is affecting my internet stability, so I may have to go off the video.
All right, sir. That's fine. That's fine.
Okay, sure. On the save for your down payment and other processing fees, it's worth mentioning that there is also equity release mortgage. I'll be explaining that subsequently. That's normally they do an LTV of 60%, which is loan to value of 60%. So mostly people may have properties that they want to bring as collateral for a loan for their business purposes, or maybe payment of fees, or any other thing that the person may need the money for. In that case, you have a property already and you are bringing it so that you release equity in it. So where you are doing an equity release, most banks will do 60% of the value of the property. So if the property values as 100,000, the mortgage firm or the lender will give you 60,000, which is a 60% of the value. I would also like to touch on applying for initial approval, because the mortgage firms here in Ghana runs on different rates. Although most of the time they tie their rates to the Ghana reference rates. If it is a GHS loan, I mean a CD loan, it will be tied to Ghana reference rates, which is GRR, plus or minus a margin. And then for a dollar loan, they will do a base rate, mostly 12.5%, plus or minus a margin. You need to shop around and then also apply for an initial approval. In the initial approval, the firm or the lender would assess your affordability. Mainly in the affordability, they rely on, one, your repayment to income. Mostly for repayment to income, it's usually between 40% to 50% of your net income. So if you earn 10,000 Ghana cedis and you want to apply for a mortgage, your repayments on a monthly basis should not be more than 50%. And then the mortgage firm factors that in their analysis. They also look at your current debt. I talk about debt to income, how much of your monthly salary goes into repayments of loans. So if maybe currently, maybe 40% of your income goes into the payment of loans, they'll factor that into their analysis. They also look at the loan to value. How much is your property worth? And then they consider the fact that they cannot give you more than 80% of the value. So all those three things comes into play when they are assessing your affordability. So if you apply for an initial approval based on your income and then your credit worthiness and then other factors, they are able to tell you that, okay, with your verifiable income information that is available to them, this is how much you can qualify for. So if maybe per your income, you qualify for 40,000 maximum. If I'm looking at dollars, $40,000 loan, that is how much they will tell you. So that you also factor that in your budgeting for the house. So if you are looking at buying a house worth 100,000, and then your income can only qualify you for 40,000, then you have to look at how you can raise money to finance the difference, which is 60,000. Where you are not able to raise up to that amount, it means that you need to be looking at properties that are lower in terms of price. You need to also research. You need to also research the loan options or the mortgage products available on the market. Currently, there are several products on the market. You have a home purchase mortgage. Home purchase is a mortgage arrangement where the bank gives you money to buy a property, and that property is taken as collateral for the loan. And then we have equity release. Equity release, you already have a property and you are bringing it for a loan to take care of other financial needs, maybe business needs or family needs. You also have a home construction or home completion loan. So where you already have a land and you need money to construct it, you can come for a mortgage, and then that will be disbursed in tranches to your contractor to develop the property for you. After the property is developed, it now becomes the collateral that the bank will use for the loan. We also have home improvement. You already have a house, but maybe it's a bit dilapidated. You want to do a facelift on the property. You can come for a mortgage to do that. There is also a refinance mortgage. Refinance mortgage basically allows the borrower to switch his or her mortgage loan from one bank to the other, mainly because of better interest rate that the other bank is offering or better customer services. So currently on the market, there are different rates running from one bank to the other. So as a would-be mortgagor, you need to shop around. You need to speak to various lenders, know their rates, because the rates affects your repayment. So you need to shop around and then know which firm offers the best rates or the best services that you would want to go for.
All right, Sir Jacob.
Yeah, hello, Godwin.
Yes, I think before you advance, let's see if we can pick some questions before we advance. I think we have done some few minutes already, so
Okay.
that if there are any questions, we can address them quickly, and then we move to the next half of the presentation. Yeah. First of all, let me just ask a few questions regarding the credit history. You mentioned that even if it is Momo you have paid, your credit history has to be checked and all of that. I want to know, are the telecommunication networks now having any link with the banks in terms of somebody's ability to repay loan? Have there been that link already? And to an individual? Is it also available to an individual? Maybe, I don't know, but that's just something I want to know. Has it been linked? Do we have a centralized system with the Momo people, as in the mobile money people, you know?
Okay, so Godwin, I see a hand up, but let me answer your question before that person comes. I
Okay.
think Ben.
Okay.
All right. So with the Momo, the Momo loans, what you need to understand is that they are underwritten by banks. So I know, I think MTN Ahomkan loan is underwritten by ABSA. So it is not MTN that is giving the loan. It is given by financial institutions. The mobile money is just a medium through which those loans are given out. So once the bank, because our Ghana cards are linked to our Momo wallets, at this point, it's easier for the banks to record your loan at the credit bureau, so that whenever they run a credit bureau search, it shows there. So just like any other loan that is given out at the banks, the Momo loans are also recorded and tracked.
All right. Thank you. Thank you very much. I think that's one of the revelations for me now, that most of those loans are written by a bank. So that's it. Mr. Ben, Sir Ben, if you can go ahead with your question.
Okay, thank you, Godwin, and thank you, Jacob, for this opportunity. I kindly want to, ask about, the nature of our economy in terms of how informalized it is, currently. And I want to know, how does the bank assess the creditworthiness of somebody who do not really have, like, a salary median that has to come to a bank? I know you have thought about the mobile money in terms of how, they can be able to ascertain that. But in terms of like the basic market woman, or the business person that may not really have that regular kind of income that comes, like, on monthly basis, or even, let's say, weekly, or how you want to describe it. How is the bank, the banking system in terms of like the mortgage industry able to cater for such people? Thank you.
Okay, Ben, thanks for your question. It's rather the case that most banks tend to rely on people who have regular income, that is salaried workers, for mortgages, because it's easily tracked. But for the informal sector, like you rightly mentioned, the market women, it's difficult to track their income on either a monthly basis or weekly basis. Although there are mortgage firms that give mortgage loans to people who are in the informal sector, self-employed people, most of the time they will be required to bring a bank statement that shows that they receive regular income. So if you earn so much but you don't channel those monies or invoice payments through a bank, it becomes difficult for the mortgage firm to assess how regular your incomes flow and whether or not you'll be able to keep to the repayment of the loan. And mind you, with a mortgage is a long-term loan that can span, in Ghana mostly, you can get it up to 20 years. And because it's a long-term loan, the firm is not only interested in giving out loans, but also your ability to keep to the repayment of the loan. And that is very crucial in their, or important in their analysis. So yes, it's difficult to track the income of people in the informal sector. But if those people can route their income flow, cash flows through the bank, it's easier for the firm to rely on the bank statement. Or if they have registered companies and they have audited financial statements, that can be used to assess their credit worthiness. I don't know if I've answered your question.
Yes, thank you. I appreciate that. Thank you.
All right, thank you. Elton, please, you can go ahead with your question.
All right, I am Elton. I think earlier in your presentation, you mentioned that the repayment of your loan should not be more than 50% of your income. The amount to be repaid should not be more than 50% of your income. So are there packages for like spouses, like partners, a husband and a wife? Do the financial institutions have packages like that for them, so that when they join their accounts, that repayment will be less than the 50% as the institutions require? Thank you.
Yes, so the financial firms have that arrangement. So one person becomes the main borrower and the other becomes a co-borrower. It's actually one of the things that I'll be talking about, but since you asked the question, I personally would advise couples or people who are married, or if you are siblings and you have good relationships, you can come together. And like you rightly said, once we put two incomes together, it increases your affordability and the amount of loan that you can access. So if that option is there, and a lot of the mortgage firms do that. First National Bank does that. So that is available.
All right, thank you.
You're welcome.
Okay. I think there's no name here. ITEL X16. Please, your hands out. You've indicated you want to speak, so kindly go ahead.
All right, thank you very much. Can you hear me?
Yes, sir. We can hear you, sir.
Yes, you can be heard.
All right, thank you very much. Godwin, thank you for the opportunity. I think it's a great initiative. Jacob, congratulations. My name is Mustafa. I would like to ask briefly some two questions before you proceed. And so basically, my first question is going to be centered on the mortgage rates. I mean, the rate of borrowing. I would like to ask, we know that as far as rate of interest is concerned, we know that rate is actually consistent with the level of risk associated with a particular investment. And so if an individual comes to a bank to borrow an amount of money for whatever purpose through the mortgage process, is the rate going to be consistent with the individual risk? Or this rate you are talking about are generalized in such a way that irrespective of the credit worthiness or irrespective of the level of income, me, myself, and Godwin, we are going to pay the same rate irrespective of the differences in our credit worthiness? Is it general or the individual rates that are applied when it comes to mortgage acquisition? So that's my first question. And so you can respond to that, then I proceed to my second question as well. Thank you. If that's clear.
Yes, that is clear. Thanks, Mustafa, for that question. So basically, in assessing the rate, the lender, which is the mortgage firm in this instance, would make reference to the national rate. And the national rate, if it's a CD loan, is the Ghana reference rate. Currently, that is around 31.13%. So if you are taking a CD loan, you must know that your loan is being pegged to a Ghana reference rate that is given by Bank of Ghana, and currently is around 31.13. And you can have a plus or minus a margin. And for CD loans, normally the margins may maybe between 5 to 10%. So if they are adding, imagine per your credit worthiness or credit history, you are rated a high risk customer. It's a range of margin that they put on the Ghana reference rate. So if they consider you high risk, then you get a higher margin. If they consider you a low risk person, then they'll give you a lower margin. But the Ghana reference rate is 30. We have other banks who are doing Ghana reference rate minus a margin, considering the economic situation that we are in currently. But what you said is right. They consider each applicant's credit worthiness or the risk level and then apply a margin. But there's a static base rate, which is the Ghana reference rate, which is around 31.13%. And then for a dollar loan, the base rate now is around 12.5%. And then they will add a margin between 1 to 4%. Yeah. Plus or minus, that 1 to plus or minus. So they can either take out from the base rate or add on to the base rate. I don't know if I'm
Yes,
able
I
to
think
answer your question. Yeah.
Yes, that's quite exhaustive. Thank you very much. And so I proceed to my second question.
Okay.
We know that as far as ownership is concerned, just like most African countries, Ghana's land ownership system is more communal. And so you have different communities and families owning land together. So that is why if you read Hernando de Soto's Mystery of Capital, he is talking about the fact that because African property systems and other countries within the South, our property systems are in such a way that they are mostly held in communal, we are not able to unleash the capital that are embedded in those kind of communal properties. And so in his Mystery of Capital, why capitalism triumphs in the West and fails everywhere else, he advocates for an individualized property. Now, my question over here is that, considering the fact that most properties in Ghana, especially when it comes to land ownership, are communal, how does this actually facilitate mortgage acquisition? If an individual comes, probably a family owner comes or a chief comes and probably would want to acquire a mortgage, any of the mortgages, whether legal or equity mortgage, and he is saying that the land is not in his individual name, but probably in the name of a corporate tenure group, a family, or a stool. How does the mortgage system in Ghana facilitate all this process? Or the mortgage system, is it only applicable when it comes to individualized property, or the communal system is also considered in the process, as far as your outreach is concerned? Thank you.
Yes, so for currently what I know happens in the market, the communal system doesn't work or is not acceptable. And probably, I don't know whether I can put it under surety mortgage, but it's still complicated when it comes to family properties. So what we would usually recommend an applicant like that to do is to get the family transfer a portion of the land into his or her name. And then that can be used as collateral for the loan. Probably if it's a land, you get the land and then you can come for a mortgage to develop it. So basically that is what happens, because getting family properties can be a bit complicated, even with the sale. So whenever people are bringing collateral or properties for a mortgage, or buying properties with a mortgage from certain areas or certain families, we rank various families in terms of risks or based on our past experiences. We may have some families that wouldn't want to advance the mortgage to. And I think recently there was a judgment that changed the ownership of a lot of land in Accra to one family, which means that the other families or the other people who have already bought from that family, that is no longer the owners or the legal owners of that land, may have to atone tenancy. And as a mortgage firm, when that happens, it's a huge risk to the bank, because in such instances, the borrower can say, okay, I'll stop repaying the loan. because besides the property is no longer mine. I need to go and pay you sum of money to get it. So for communal properties, no, that's from my experience, I've not had any such encounter. What I know happens is that if it's a company, registered company property, that can be used for an individual or an individual using his private property for a mortgage for a company. And in that case, it's called a surety mortgage.
All right, Jacob, I'm okay. Thank you very much.
Okay, thank you, Mustafa.
All right, so Jake, you can continue with your presentation, and then maybe in the next half again, or to the end, then we will take other sets of questions that may emerge. Thank you.
Okay, so one other thing that would be mortgagors would have to know is that when you take a mortgage, you are required to take an insurance over the property. So that is a general insurance. So you need to research on the market. Usually it's about 0.15% of the property value. So you need to know that that will be required of you, and you need to research to know which insurance firms are offering the best rates. I know some banks may have certain insurance companies that they would want to work with, but usually once the insurance company is listed, you should be fine with that. People would normally just go for general insurance, or some companies would just emphasize on general insurance without talking about life insurance. But I would recommend that if you are going for a mortgage, knowing that it's a long-term loan and no one can predict the future, it will be advisable that you take a life insurance so that in the event that the mortgagor passes on, it doesn't become a burden to the already bereaved family, that sometimes people end up losing the property because they are not able to keep up to the repayment of the loan after the passing of the main mortgagor. So it's always advisable that if you are going for a mortgage or a huge debt in the form of a loan, you take a life insurance so that you don't place a burden on your family in the event that you pass on. Again, as much as possible, as a would-be borrower, you need to borrow in the currency in which you earn. What do I mean by this? If you maybe you earn in cedis, and then because dollar mortgages have a better rate, you would want to go for a dollar mortgage. What you must bear in mind is that should you take that decision, whenever the currency depreciates, you need more cedis to repay your loan. And that is happening to people who took loans, mortgage loans in dollars, but earn in cedis around, let me say before 2021. So all those people are now, will be struggling with their loan repayment, because imagine the time where a dollar is equivalent to 2 cedis. And then currently where we are hitting over 12 cedis to the dollar, it means that you need 6 times of what you used to pay in cedis previously in order to service your loan. And that can create a huge burden. And if you don't take care, you fall into default, and then the bank will come for the property and sell it at a for sale value. And you may end up not even getting any money at all. So my advice would be that as much as possible, take in the currency in which you earn. But if, for the sake of interest rate, you would want to take a mortgage in a foreign denominated currency like the dollar, because currently dollar loans you can get between 12.5 to 14%. Meanwhile, the CD loans are hitting over 35%. And you want to take a dollar loan, then you must set something aside like a sinking fund, or whenever you have a spare money coming through, you use that money to reduce your principal, because the interest you pay at any point is based on your outstanding principal. So once you come to make prepayment, although it comes at a charge which is normally 0.25% of the amount that you are using to reduce your principal. I don't know if I'm speaking too much of technical terms, or I'm being understood. Godwin.
Yes, sir. Yeah, so
Hi, Godwin.
Yes, sir,
Are you getting the point on the reduction of principal reduction?
Maybe you can break it down you can break it down further if that's possible for you. Yes, sir.
Okay, let me break it down.
Yes, sir.
So I mentioned that as much as possible, if you earn in CDs, take a CD mortgage or a CD loan. If you earn in dollars, take a dollar loan. Because if you earn in CDs and you take a dollar loan, your repayment will be in dollars. And as the CD depreciates, you need more CDs to pay the same amount of money in dollars that you used to pay. And I even made an example that those who took mortgage loans in dollars and they were earning in CDs, and at the time, the exchange rate was 2 CDs to the dollar. Now it's around 12 CDs. What it means is that you need about 6 times the amount 6 times the CD amount in order to pay your dollar, to keep to your dollar repayment. So because of that, should you go for a dollar mortgage because of the interest rate, then what you must bear in mind is that you must have kind of a sinking fund or some kind of extra income. You must create an extra income. And the purpose of that extra income is not for you to have extra money to spend, but extra money to buy dollars. So that in the event that the CD depreciates or your local currency is depreciating, you can use that money to even make up for the difference in your repayment or reduce your principal. When you reduce your principal and you maintain your loan tenure, what it means is that your monthly repayment will go down. So if your monthly repayment go down, you'll be able to keep up to it, although there may be some kind of additions in terms of CD that you need to add to your previous repayment, but that burden would have reduced. So that is what I'm trying to explain. And I think I touched on the married couples already, that you can come for a joint application for a mortgage. It increases your affordability, and then you're able to get a higher loan amount. Then let me also touch on registration. That would work more for people who will be bringing in their collateral, I mean their property for a loan. In this case, an equity release mortgage. For an equity release mortgage, you already have a property. The banks would always want to receive a registered title. So if you have an indenture, make sure you send it to the Lands Commission, you get it registered, because that would also affect your whether they will give you the loan or not. So you need to make sure that if you have a title document, you perfect it at the Lands Commission. Even if you are not bringing a collateral, but you are coming for a mortgage to purchase a property, make sure that your vendor has a registered title, because most banks would want to get collaterals that have been registered before. So that is another thing to note. So basically the points I have here, I've exhausted them so that if there are more questions, I take them and then we'll see how it goes.
All right. Thank you. I think I saw a hand up. There are some questions. There is one question actually in the chat box as well. But before I read that, let me give the opportunity to Sarah Guafo. I saw your hand up so that you can ask your question.
Hi, thank you, Mr. Jacob, for your presentation. So, whilst presenting, you mentioned that when you buy your mortgage or you purchase your mortgage in a different currency like dollar, you need to set up a sinking fund account, or the moment you get money, you have to pay some so that your outstanding loan balance will reduce since you pay your interest based on that. So I think we are also aware that banks also experience some form of risks called callable risks when, let's say, you own them, and then based on the time duration or the duration given, you don't pay it on that time. They also experience some kind of risks. Let's say the agreement was 25 years mortgage, and then after 3 years, you get the money. Let's say you win a lottery and you go and pay them. Is there any form of risk they experience? And then if so, are there any kind of rates or restrictions they placed on that? Yeah, thank you.
Okay, thanks for your question, Sarah. So I think for every bank, whatever inflows that come into your account, they have the right to question you as to the source of that money. And I think as part of the initial things that they require is to do a KYC to know the kind of customer that they are dealing with. Are you a politically exposed person? Blah, blah, blah. They check all those things. So yes, not only for mortgages, but banks always check the source of your money, and you should be able to prove it at all times. But in fact, with what I'm even talking about, if you are saving the money, for instance, you are always converting your extra income to dollars and keeping it in your dollar account with the bank, there's always a track record of you making deposits into that account. If it's a one-time payment and you have a proof of that payment, maybe probably you made a sale of a property or you sold your car, there will always be maybe a sales and purchase agreement or I would say a receipt to always show or to prove the source of your funds. So I don't think that will be too much of a risk to the bank. They will always ask, but if they ask and they realize that the source is not genuine, they can also report you.
Okay, before I give you the chance, I think let me see if I could ask a follow-up question with respect to the answer you give to Sarah. So does it mean that, because I think one-off payment doesn't mean it doesn't have any specific effect on the bank? Because I think that is what Sarah's question is more tuned towards. If there is a one-off payment, does it have any effect on the bank? And
You mean paying off your loan at a go?
Yes. And is
so
there
that
any...
is why.
Yeah.
Okay. Sorry. So if I understand you, I think there is a penal charge to that though. So whenever you are making a prepayment or you are paying off your loan before the scheduled time, there is a penal payment of 0.25% of the amount that you are paying. So if you are paying $10,000, they will calculate 0.25% of that $10,000, and then you pay that as a penal charge. I think that should be around $250. Yes, but compared to the long-term interest that you'll be paying on that same principal, trust me, it's better to pay the penal charge of 0.25 and then save yourself the hassle of paying a lot of interest to the bank.
All right, thank you. Sabin, please, you can go ahead.
Okay, thank you once again, Jacob, and I really appreciate the answer you gave to Mustafa concerning the communal, land ownership system. That was something that I was thinking about and wanting to really find out, and it's really been educative for me to hear, this experience, kind of your experience you share with us. I really appreciate that. But then again, I actually haven't concerns about this idea of formalization and what it means to have a formal title, and we know in our Ghanaian system where we know that title itself does not guarantee ownership, right? And I want to know with your experience, do we have circumstances where, the bank will go beyond just, looking at the title to say that, if you have ownership in terms of community or being in community, and everyone recognizes that the land belongs to you, then you don't necessarily have to show proof of title in terms of like an indenture or a T document, in that context, in with your experience. And then my next question is with regards to corporations. I did some work with cooperative societies, and they tend to sometimes, get loans and then just support their individuals in terms of like providing them with, short-term loans to provide their own homes on the incremental basis of, servicing their homes or kind of like even providing homes for themselves. And I want to know, do the bank also consider like, does it matter in terms of the time frame that is given to corporations as compared to loans that are given to individuals? I'm talking about the time frame. Do they have, flexibility in terms of like whether long-term arrangement for them or even is it going to be shorter, or the other way around in terms of your experience? Thank you.
All right, thank you, Ben, for the question. Because the loans that are given are more of legal mortgages, and in fact, the regulator would also request for those documents for their audits, BOG, from time to time. Banks would always want to receive a title document. And for me, I don't know if there is any bank that will give loan based on confirmation that the land belongs to a particular person. But ownership in this country stands more, although, well, you may have a title document, but your ownership may still be in doubt. To a large extent, if you have a title document over a property, it's assumed that you own it until it's proven otherwise. And then secondly, on the corporations, most of the time for corporate entities, they fall under commercial or maybe corporate loans. And those loans normally, they have a short tenure, but they are subject to renewal. So you may have 12 months, a mortgage by 12 months, or maybe 24 months. And then after the period, you would renew it. So that is how the corporate loans or the commercial loans work. I don't know if I've been able to answer you.
Yeah. Thank you. I appreciate that. Thank you. Yeah.
All right, Ethan, please, you can go ahead with your question.
All right. You mentioned that the repayment period for the loans, maximum period is 30 years. First, I want to find out, is it like in all countries across the world? And also in Ghana, you mentioned that it's up to 20 years. Any particular reason that our repayment period is less than the 30?
Actually, in fact, you can have, although we say that you have up to 20 years to pay, it also depends on your age. So if you're a salaried worker and you are 50 years, and then you are applying for a mortgage at your 50th year, you only have 10 years to repay your loan. In terms of why most companies shorten, well, we are not running 30 years in Ghana. From my experience, I know that when you take a mortgage, the first 5 years, the bank takes more of interest than principal payment. So your repayments of, say, maybe 5,000 could be, when you split it, when you see the amortization schedule, you know that you are paying an interest of about 4,500 and then just repayment of principal of like 500. So after 10 years, actually after 10 years, your mortgage loan doesn't become profitable to the bank anymore. Because after 10 years, what you'll be paying will be more of principal than interest. And they are more interested in their interest. So with amortization schedule, the first few years, you pay more of interest. So really, they will make more of their money upfront. So there's no need delaying the repayment of the loan. I guess that answers your question. But in other jurisdictions, you can get up to 30 years. But it's also dependent on your age, if you are a salaried worker. But if you are a self-employed person, age also matters, but they also look at your cash flows. Yeah.
Wow. Thank you. Emmanuel, Manuel, okay. You can go ahead with your question. I wanted to ask something, but I think after Manuel, I'll come out with my question as well.
Hi, Godwin, and hi, Makati. Thank you for organizing this. My question have to relate to affordability, right? With rates as high as 30 plus, how are we? What are we doing to make sure that we are trying to include the low income households? Because if, for instance, I'm expected to provide a down payment of 20%, which is understandable, but with such high rates, it's just like we are pricing out a certain category and we are just leaving this to only the high income earners in the system. So what options are available to the low income earners, and what are the refinancing options available to the borrowers in general? Thank you.
Okay, thanks. So, Manuel, I think I mentioned earlier that the rates are based on government rates or the central government's rate. So the financing entities also look at the Ghana reference rate or the base rate before determining their rates. And it's unfortunate that mortgages are not affordable to low and even middle income earners. In general, currently, for you to be able to access $80,000 loan for a house, you should be earning at least $2,500 or its equivalent in Ghana cedis. So that is how unaffordable it is to a lot of Ghanaians because of the interest rates. Even for, I mean, dollar loans that have lower interest rates, you need to be earning that much before. If you earn in those currencies, like our brothers who live in the diaspora, they have advantage because that is the currency in which they are paid. But if you earn in cedis, then it becomes a wahala. So really, mortgages in Ghana are not affordable to the low income earners. And from research that I have done, I noticed that they cannot afford, even middle income earners cannot afford. And because of that, if you are middle income earners, unless you are coming as a couple and then choosing a property that falls within your budget, It means that you shouldn't be looking at high-end properties, but ones that are within maybe 500,000, 400,000 Ghana cedis, those kind of properties. So that is what I have to say on that. On your second question, I think I missed that. I think I missed your second question.
Yes, I was asking about refinancing options. From what I understand, the mortgage system in Ghana is not really developed, and it's been dominated by a few banks. So, if so, what are the refinancing options available to the borrowers? I'm asking this because you can have a loan term of, let's say, 10 years, but then you can actually arrange to have an amortization period of about 30 years. So that at the end of the 10 years, maybe you get another lender, right? But is that something that is easy to find in the Ghanaian mortgage market?
Yes, it is. We have loans moving from one bank to the other all the time. So basically, you need to go and negotiate for a rate that is lower than what you are currently being offered. And then once you have a better rate, that bank pays off your current lender and then take on the loan. So when you move it to another bank, you can probably negotiate a longer tenure once your age can take you that far. So somebody said we resort to look at mad homes. Anyway, for me, I would suggest incremental housing for low and middle income earners. If you're able to buy a land, or probably you take a mortgage to buy a land, which will be cheaper because land may not be so expensive. And then as and when you make more money, you start developing it. So that could be my suggestion. I can see more hands, Godwin. So
Yes. Ben, you can have a shot at this.
Okay, thank you very much, Jacob. I think this session is really educative. That is why I know people are excited to find more, answers to questions and stuff. I appreciate it. Yeah. Jacob, I currently want to find out where, with regards, people have been talking about the idea of using pension, as a guarantee kind of, for home financing or getting a mortgage. Because the argument is that there's no sense in, not having a home to live in. At the retirement age, you're thinking about getting a home, right? So, has there been any improvement in terms of like work between SNIT and this mortgage institutions to kind of like facilitate that particular arrangement for mortgage financing? Thank you.
yes, thanks. Ben, I actually agree with that. I know one mortgage firm is working on something like that, where they would want SNIT to have that arrangement with SNIT where we can have pension-backed mortgages. But I don't know how far that conversation has gone. But I know SNITs themselves, sometimes they struggle to even pay their pensioners. And I know sometimes they invest in real estate projects, which may not be profitable. So I agree. I know some banks are working on that. So let's see how that goes. But that would have been a very great idea or a good initiative.
Well, that's right. I think it's a similar thing that I've read about in Singapore. It would be very interesting to have it in Ghana here. Let's move to Elton. Elton, please, you can go ahead.
Thank you.
Yeah.
On default, what happens to the property? What happens to when an individual defaults on their mortgage loan? What happens afterwards? And we know about let me just say so I've heard of foreclosure. How is that process like, and how easy is it for the banks to carry it out?
So as you rightly mentioned, the term is called foreclosure. So currently, if you default on your loan for, I think, at least 3 months, and you've not made any effort to pay or you are not able to pay, then the lender will trigger that process. And I think one thing that is helping the mortgage lenders now is the Borrowers and Lenders Act that brought into force the collateral registry. So Bank of Ghana has a collateral registry where every mortgage loan that is financed, they record that in the registry and then the details of the collateral. I think that mainly was to prevent fraudulent activities where someone can just take his collateral to 2 different banks, processing them at the same time, where one bank did not know the other one is also processing a loan on the same collateral, and then the 2 of them end up disbursing the loan on the same collateral without knowing. I mean, people can have duplicates of their land title certificate, duplicates of their indentures and all that. So the lenders are supposed to run a search on the portal to know whether that particular collateral has been taken by another bank for a loan or not. And then you are supposed to register it. You know, the process, if you have to go through court, is very lengthy. So because of that, the collateral registry allows the lenders to trigger how do you call it, notification of default. So if they are able to trigger notification of default because they've registered the loan or the collateral, then they have up to 5 days to serve a notice on the borrower. Then the borrower must come if he has a payment plan or he want the lender to give him or her a payment break or kind of a payment holiday, so that maybe probably they've lost their job, or if there is, I mean, enough reason behind that, the bank can say, okay, we will not take any interest or repayment from you, but that interest will be added to your principal, so that when you bounce back, maybe 3 to 6 months, then you continue the repayment of your loan. But if the borrower is not able to do that, or is not able to raise money to clear his or her debt, then the collateral registry, with that the trigger of notification of this default, they are able to send there is a process that they go through the court, but it's shorter than making a legal suit to claim the property. And then when that happens, what happens is that the court allows the lender to sell the property, but at a for sale value. So if your property's market value is, say, 100,000, normally for sale value is about 70-75%. So it means that they are selling your property less than how much is worth, number one. And then probably if you are within your first 5 years, most of the money you've paid, about 85% of whatever you've paid has gone into interest payment, which means that you have a chunk of your principal outstanding. And then sometimes they even sell and it's not enough to even cater for your outstanding debt. So that is how the process works. Because of collateral registry, it is shortened, but at the end of the day, it will be sold. If they are not able to get a market value, they can sell at for sale value. The court permits them to do that.
All right. Thank you very much. Thank you for that response. So it means the banks could actually sell without going to the bank, without going to the court, based on the that clause we have in the Borrowers and Lenders Act, as you mentioned.
Yes, not because they cannot go to the bank, but that shortens the process.
Okay.
So at the end of the day, it will still be a court sale, but with that clause, they are able to go through the process quickly. So once they give you they serve you a notice, and then you don't respond within a certain period, then they are going straight to the court to ask that they should give them the mandate to come and take over your property and sell.
Okay. All right. Thank you very much. Mustafa, please, you can go ahead.
Yes, thank you very much, Godwin. I think based on the conversation, the challenge we have at the moment as far as the mortgage market in Ghana is concerned has to do with the high rate of interest. And so obviously that is pricing a lot of people out of that particular market. Now, basically, I think this is more of a conventional kind of mortgage system we have. But at a global level, I know that we also have within the Islamic world, we have what we call the Islamic banking, which obviously, it actually being instituted in most countries across the West as well as even in Africa. Now, the Islamic banking works on the principle that there is no interest on the loans that you usually come for. And so what they do is that if you are coming for an equity mortgage, for instance, probably you are going for a mortgage for investment purpose. What they do is that they would enter into a partnership agreement with the mortgagor. So of course they've advanced the loan to you, but then unlike the conventional banking system where we give the loan to you irrespective of whether you run at a loss or whether you make profit, you still have to pay the interest. Here, when it comes to Islamic banking, what they are saying is that they are going to share the risk with you. And so if you make profit, we make profit together. And so they share in the profit. And if they make a loss, they also make a loss together. Now, Jacob, what I want to ask is that within this particular space, in the Ghanaian mortgage market space, has there been any kind of conversation where we are able to integrate this kind of principle, or more or less like having some of these Islamic banking principles being the conversation that we are going to have such an Islamic banking system being implemented? Because I heard of something like that, but it appears that to minimize that kind of difficulty people encounter when it comes to mortgage acquisition.
Yes, for the traditional banks that we have, they are in for interest or for profit. So for them, obviously, they wouldn't want to go into such arrangements. But let's hope that the Islamic bank is able to come to Ghana so that they can help people who may want mortgages but are priced out from the traditional banks.
Okay, yeah, all right.
So just an add on to the question he asked earlier, if that should happen, is there any way it's going to disrupt the traditional banking system? And are we going to have any mishaps?
I don't think so, because if you watch globally, in fact, I know some mortgage firms or lenders who are financed by international corporations like the IFC, the DEG, the Shelter Afrique, and all those international corporations, because they may have a target or a goal to ensure that people are able to get homes. So they are providing funding to these lenders so that they will be able to offer affordable mortgages to people around. So we have corporations like that. So I don't think this would be a distraction to the market at all. In fact, it will make the market more competitive if that happens.
All right, thank you. Thank you very much. Okay, so we'll move to Samuel. Samuel, please, you can go ahead and fire.
Oh, okay. Thanks, Mr. McCarthy and Sir Gordon, for this opportunity. My question, first of all, relates to, I think this presentation is a complete presentation, but let's assume that the person interested in getting a property or acquiring the property has everything like on his side. Let's assume Gordon is going for equity release mortgage or going for maybe loan to buy a property, and you have all your things, like let me say, intact, that the bank is ready or the person who is financing is ready to give you the money. But does the bank play a role in helping you to like use the money in acquiring a good property? Because it's one thing for you to be like, let me say, a qualified candidate to get the money, but it's one thing also for you to invest in the right property. Let's assume maybe you're going to buy a house. Do you need to do that private check on your own to know that amount of money that you're getting, that you're going to use to acquire the loan is legit and you're not going to lose your money? And also on the second note is considering Ghana's economy and everything that we are in, do you think mortgage is an ideal approach? Because let's assume someone who is, let me say, even above average or even in the average class, acquiring or earning good money, do you think mortgage is the right approach? Because we know that our economy is highly influenced by the next person that takes on the seat. I hope my question is clear.
Yes, your question is clear. So let me tackle the first question. So in fact, the mortgage firm, let me put it this way. If you are bringing a property for a loan, that is equity release, or you are coming for a loan to buy a property like a home purchase mortgage, more or less it's like you are selling the property to the bank, because the bank has given you money and is holding on to something called a collateral property. So as part of the process with the mortgage financing, you will go through due diligence and valuation. So valuation one, to confirm whether the property is worth the price that they are even mentioning, so that we know that, okay, this is the value of the property. For instance, if the property values are $50,000 and your vendor is quoting $100,000, then even you, the buyer, should know that no, I'm going for a wrong property, and we will not give you a loan more than 80% of that value. So if it is $50,000 value that we have, that is what the lender is going to give you. So 80% of that brings it to 40,000. So which means that you have to raise the balance if you still want to go for that property. So there is rigorous due diligence that is carried out on the property to ensure that it is free from all encumbrances, to ensure that no other family has interest in it, to ensure that the one selling to you is the right person who is selling. So they do kind of a vendor due diligence. The bank even visits the vendor, try to know who the vendor is, the history behind the vendor. So they do a thorough due diligence before they accept a collateral, because if you are bringing equity release, it's like you are selling the property to the bank for money. So the bank will also go through their rigorous process to ensure that whatever they are taking on is a good collateral per their checklist. Secondly, you asked a question as to whether mortgage is the way to go for home ownership. In Ghana, I would say that it may not, because of interest rate, but if you go elsewhere, it's actually supposed to be the ideal process, because what happens is this: if a young man, I want to acquire property, I will start saving towards it. Whilst I save towards it, prices of properties go up. Then what happens? You may be saving for like 30 years and you've not even gotten enough money to buy a property. So, and the issue with land purchase too is that sometimes when it's a bare land, you may have people coming in for issues and all that. But once it's going through a mortgage, the firm will also do due diligence on the land and be sure that this is a good land. So I would say that you can take a mortgage to buy a bare land. Then as and when you have extra funds, you'll be developing it as you go. If you don't have the capacity or you are not qualified to go for a mortgage to purchase a house, take mortgage to buy a land and then start developing it. If you have the land, try and fence it, secure it, because the mortgage firm will ensure that the documentation is tight, because they are also taking on a certain risk. So they need to ensure that the collateral is free from all encumbrances. Then you will also have to physically protect the property by maybe fencing it. And then probably if you have extra income, you start developing it. So that would be my comment on your second question and your first one as well.
And the
All right. Thank you. Thank you, Jake. Mustafa is on the line now.
Yes.
Okay.
I want to come on the loan to value ratio of 80%. Jacob, I would like to find out, is this a fixed rate? Because I believe that it should be based on the location and the sellability in an area that after default it will be. And I believe that even the bank should be ready to give about 100%. Is that not it? But obviously it's not going to happen. And if a property is located in an area where it will take time for you to get a buyer, I believe that that should also inform. But in practice, is it a fixed rate, or it varies, changes from time to time, or probably it's property specific depending on the sellability and location? What has been the
Okay, so maybe let me clarify. The 80% is not a fixed rate. It is the maximum per policy. It could be the bank's policy. I know most banks, for a home purchase, their policy is that they do a maximum of 80%. Where in extreme cases, you can have 100% financing, but there is a certain kind of insurance that is taken on that kind of financing. I think I don't seem to remember the insurance policy, the type of policy, but in extreme cases, they do 100% financing. And like you mentioned, they look at the sellability and all that. Those things also inform them as to whether they should grant the loan or not. So those things happen in the analysis of your application.
All right, Jacob, thanks.
Okay. There is one question here in the chat box as well. Hi, Makati. Do we have mortgage brokers leading the process on behalf of borrowers? If no, have individuals expressed willingness to engage these agents?
I personally don't know about mortgage brokers. There may be mortgage brokers, but what happens is that these lenders normally have their platforms like websites, and they do adverts and all those things. So you may even have their sales, they have sales team that also sell the mortgages. Those people will guide you through the process, what documents you need to submit, what you need to do, and all that. So the mortgage lenders have sales persons that handle the process or engage prospective customers on what to do and what not to do. But I think there may be mortgage agents, but I don't know of any of them at the moment.
Okay. Thank you. Thank you very much for that response. Are there any other questions available there? If you have any other questions and you would want to ask, I think we have some few minutes more to go. Else?
I think, okay.
Okay.
I think, Godwin, there's a question that we've missed from Christian Togbo. He said, I have never borrowed before, so
okay.
I have no credit history with any institution. How does the bank assess my ability to commit to repayment of the loan? Yes, so if you don't have any credit history, the bank will still go ahead and then finance it once your income qualifies you. Maybe that could be your first. I know a lot of people who do not have any credit history because they've never borrowed before, but as a first time, they are able to get a mortgage. So it also depends on your income and then other things that they may look at.
All right. I was actually talking off the mic. Sorry about that. Okay. So there is one last question in the chat box. But then I would engage Ben first to ask his question, and then we can take the one in the box.
Okay.
Ben, please, you can go ahead.
Okay. Thank you once again. Jacob, I kindly want to find out about the insurance in terms of, I think you talk about, you have to put up a life insurance as part of the mortgage, if I get it correctly. And I want to know, does the bank allow you, the borrower to have that flexibility in terms of like negotiating, if possibly, bringing in your own kind of insurance arrangement, and if that is available, or even let's say waiving that option but translating it into the interest rate or something. Like, I'm just trying to find out, like, is that kind of like negotiation that go through these processes when it comes to the mortgage contract that is being meted out in that arrangement? Yes. Okay. Thank you.
Okay, thanks. So one, let me state emphatically that for general insurance, no company will waive it because of uncertainties and the risks involved. So for the insurance against fire, natural disasters like flood, earthquake, and those things, no mortgage firm would waive that, or no mortgagee will waive that for you. In terms of rates, I think sometimes you are able to negotiate rate, especially the margin that is placed on it. And for life insurance, most companies do not make it compulsory, but as I explained earlier, it is for your own benefit, or it will be in the interest of the mortgagor or the borrower to have that, so that in the event where the unexpected happens, there's a cover for you.
All right. I'm sure, Ben, you've been answered. And if there are no questions, I think the last question in the chat box has been responded to by Jacob. So if there are no other questions, then I would take the last words of Jacob, and then we can close the session for today. If you haven't registered, you can register. We have your email address. We'll be sending you updates when we have other sessions. We would let you know. I think the link will be active from today to tomorrow. I'll close it, and then maybe if we have another session, we would also reshare a link. In case you would also want to share your experiences with us here, that would also be important. You can contact us, and then we see how we can get you on. Emmanuel, before you come on, let me take Emmanuel's question, and then you can.
Okay.
Yeah. Hi, Makati. Thank you for sharing this insight with us. So in your professional opinion, what is the outlook of the Ghanaian mortgage market going forward? What are some of the things we can do, maybe as professionals and also from the government, to kind of improve home financing options, maybe capture everyone and not just let it be something that is accessible to the high income earners? Thank you.
Okay, so I would say interest rate. So government should, government really wants to increase home ownership, because already there's a huge deficit that we are dealing with. Then they should be looking at probably working with the banks so that they can offer affordable interest rates. Also, government can do construction of homes, because we also notice that the house prices are going so high. And because it's controlled mainly by the private sector, they kind of influence prices up a lot. So if governments through its agencies like TDC and then State Housing Corporation, I know they are doing a couple of projects, but if they can do more of that and make it more affordable, then, I mean, if you are coming for a loan, it's either the loan amount is huge, that would disqualify you, or the interest rate is high, that would disqualify you. So if we have properties that are affordable, then, I mean, it can be easily accessed by people. And then if the interest rates are also reduced, then it can make it even more affordable to people. So for me, two things, or probably have some kind of tax exemptions on importation of certain building materials that will also reduce the cost of construction. But I wonder whether Ghanaians will actually consider that in pricing their houses, because really the Ghanaian is I don't want to put it in the way that will make people feel, but naturally the Ghanaian is selfish or would want to get more from whatever he does. So probably that may not be the best option, but like I mentioned earlier, interest rates can be brought down, and then government can also look at putting up houses that can be more affordable to a lot of people. Or maybe have service plots that can be sold with a mortgage. So when you buy the service plot, then you develop it at your own pace. So that would be my comment on that.
All right. Thank you. I think you should be preparing your last comment. Sarah, you go ahead. Emmanuel, sorry, Sarah, before you, Emmanuel, please, were you going to say something else? I think maybe you had wanted to ask a follow-up question.
It's fine. Thank you.
All right. Okay. Thank you.
Okay, thank you, Wakafuis. But I was wondering that in as much as we want to solve this housing and mortgage problems, can we also attribute some of these problems to our land ownership? Because I feel we all know that in Ghana, about 80% of the land are being owned by the private individuals. So looking at this, I feel, and then even though with the 20% the government owes, we would say it's not everything that they've been able to develop. But looking at these Asian countries like China, Singapore, who have made impacts, I think for about 30 years now, most of them use government intervention in securing social housing and affordable housing projects. So I think, yeah, what he said is indeed correct. But how about this private ownership system that exists in Ghana? Are we going to make that impact in the long run, in as much as we have this land ownership scheme or system? We can think about this and then, yeah, reflect on it.
Yeah, it's something that bothers me as well. But currently, it will be difficult to move land ownership to government, looking at the way the scattered families own lands, and it's difficult. They are even pulling each other to court all the time about whether or not these families are the rightful owners and all that. So yeah, that could have been the way out. But looking at how things are right now, maybe Mustafa, you are more into research on land governance and those things, but I don't know how government can look at this. Maybe they will use compulsory acquisition, but that will also come at a cost. So which will in turn affect affect the pricing of the houses. But yeah, that could have been the way out.
Yeah, thank you. Actually, even now, governments have resorted to retaining most of the lands. They are calling it divesting. So even the 20% interest 20% that we attribute to government, that the private sector owns 80% of the land, is even at stake as we speak. So the land keeps it keeps reversing to the people. So there are a lot of things that are changing, and I don't know if they will ever reverse that policy of divesting and maybe get more of the lands or something. Yeah. But if there are no other questions, then Sarah, you want to say something else?
Oh, it's okay. No, that's fine. That's fine. Yeah, because you said it all.
Okay. All right.
You said it all.
Okay. Thank you. Sajik, please, I'll take your last comment, and then we can close today's session. Yes.
Okay, so I would say it's been a very wonderful session. I like the questions that came in, the contributions from the participants. As young people, I think we should be thinking in a positive way, how we can get things moving. And mortgage could be one of the rightful ways of getting part of our housing issues solved. It's just unfortunate that we live in a country where the interest rates and things like that are high, but that shouldn't stop us. I think if you can do a land purchase, even for a half plot with a mortgage, it's better. Then at your own pace, you can be doing some kind of construction. If you're a couple, you can come jointly and then acquire a mortgage and get your house. Actually, if you want to save towards housing, it may take you several years to do that. But at least if you can start with the first step of maybe getting a land, that could also work. So my final comment would be that we shouldn't outrightly say mortgages are not the ideal way to go because of interest rates. But if not for a property itself, the land may be cheaper. And then despite the interest rate, you can still get something that you can afford.
All right. Thank you so much. Thank you. I think Ben is asking how he can get in touch with you, maybe your contact details, in case somebody wants further consultation on this. That would also be helpful to them.
Okay,
maybe you would
so
want to.
I'm typing my email in the chat box. If you want to get me, you can get me by email. I'll give you my cell phone number. So you should get my mail in the chat box. I think I missed something. Yeah. Then my contacts. Okay.
All right. Thank you, Jacob.
Okay.
Yeah, thank you.
I think I went off at a point. Yes. Thank you for a brilliant, presentation. For those of our colleagues who do not know you, they need to understand that you were actually a guru in this field, and I believe that at any point, when they reach out to you, you'll be able to give them a very good service. Thank you.
All right.
Yeah,
thank you, everybody. I have sent Jacob's number, his email address, and his LinkedIn profile to the chat box right away. You can use that to get in touch with him. Maybe when you are able to reach him via any of that, you can take further conversations and get in touch with him. So for now, thank you so much for joining in our further sessions. I would, if you are here and you want to engage, share your knowledge with us, or you are also welcome. We'll be having this session hopefully next month again, or in a couple of weeks' time. We'll inform you duly when the next section will be available. So for now, thank you so much for joining. The recording will be available on our YouTube channel. I'll share with you. Thank you so much. All right. Have a good weekend.
All right. Thank you, Godwin. And Good. Everyone should have a good weekend.
Sure.
Have a good
Okay.
weekend. Bye.
Bye.
Bye.